If you've been watching markets lately, it can feel like every road leads back to the same word, AI. AI stocks, AI chips, AI data centers. AI is transforming everything, and the question I keep getting as a portfolio manager is, are we in an AI bubble? Okay, so let's talk about it in plain English, and then I'll tie it back to the kind of long-term investing rules that actually protect people when stories like this get loud. Now, firstly, a bubble isn't just prices went up a lot. A bubble is really when prices disconnect from reality and when the story becomes so powerful that investors stop asking important questions like, how does this company actually make money? What's this company's competition? What could go wrong for this company? And what price am I paying today for their future profits, right? Now, let's think back to the dot-com era. The internet was definitely real and was about to change the whole world, but a lot of investments were priced as if every company was guaranteed to win. So with AI, here's my belief. AI is real, and the spending going into it today is definitely real. But the question is whether the pricing is getting ahead of the profits. Now, first of all, the numbers in AI are huge. So big tech is pouring an extraordinary amount of money into AI infrastructure and data center build out. It's what's being billed the AI arms race. And some estimates have the largest hyperscalers collectively spending hundreds of billions of dollars in capital expenditures in 2025, largely tied to their AI rollout. So the market has definitely gotten top heavy, and the Magnificent Seven have become an unusually large share of the S&P 500, roughly in the mid 30% range by cap weight, depending on the calculation and the date. So when leadership is that concentrated, it creates a fragile market dynamic. If a few names stumble, the index will feel it. So third, we're seeing classic bubble psychology pop up. Even some veteran investors, like one I follow closely, Howard Marks over at Oaktree Capital, he recently wrote about how this environment has bubble characteristics and why it's particularly complicated. And here's the strongest counterpoint to it. Unlike many of the past manias, some of the biggest AI beneficiaries are generating very real revenue right now and not just hype. For example, Nvidia, it's reported quarterly revenue of $57 billion for the quarter that ended in October 2025, and data center revenue is up $51 billion, which is up sharply over the last year. And that matters a lot because one of the easiest ways to spot pure bubbles is when a company has no earnings, no cash flow, no paying customers, basically just a pitch deck and a dream. So in today's AI market, a portion of the rally is being powered by real demand. Cloud providers and enterprises, they're buying compute because they believe it will save labor, improve productivity, and help them create new products. So I don't think the smartest framing is asking a straight question like, is AI a bubble, yes or no? In my opinion, a better framing is some areas of the market could be overhyped and overpriced, while other areas are legit, profitable, and you might even still be early. So as an investor, you don't want a simple opinion, you want a process, whether that's regarding AI stocks or any other sector really. So here are 3 practical bubble tests that you can use when you're looking at your stocks. Ask yourself, what has to go right for this price to make sense? For instance, if a company needs perfection for 10 years, no competition, no margin pressure, no regulation, no recession, that's not investing, that's hoping. Ask yourself, how much of my return depends on a tiny handful of stocks? For instance, when markets get concentrated, it doesn't mean you must sell everything. It means you should manage position size and avoid building a portfolio that's basically one theme wearing different clothes. And ask yourself, if this stock or this company or this sector drops 40 to 50%, what would I do? Because bubbles don't usually end with a nice and gentle 5% pullback. They end with violent volatility. And the people who get hurt the most are the ones who thought they were long-term investors until their emotions get the best of them during the first big drawdown. So What should a long-term investor do with all this? Number one, diversify on purpose. Don't just own multiple stocks, own multiple types of return drivers, sectors, different geographies, even different styles like value or growth. Number two, rebalance instead of just predicting. If something runs up and becomes too big in your portfolio, trim it back to your target. If it sells off, but your thesis and long-term plan still make sense, then it might be a good opportunity to rebalance in. And this is really one of the cleanest ways to manage bubbles without pretending that you can time the top. Number three, make sure whoever is managing your money, whether it's yourself or a hired professional, make sure they understand the businesses that you're invested in. If you can't explain it in simple terms, how a company earns money and why it can defend its profits, you're not investing, you are speculating. And finally, number four, if all else fails, seriously guys, just buy the index fund. For most people, the most reliable anti-bubble strategy is broad diversification, low costs, and consistently investing over time. Because if you don't have the time or interest to analyze businesses and valuations and listen to earnings calls, then really a diversified index approach can help you from making the classic investment mistakes, which is getting emotional about your investments at exactly the wrong time. So to recap, are we in an AI bubble? My view is AI is a real revolution, but some parts of the market may be pricing in a perfect future. The opportunity is real and the risk is real, so the answer isn't panic or blind enthusiasm. The answer is discipline in your allocation and sticking to a process without getting emotional about it. Because long-term wealth isn't built by guessing the next headline, it's built by staying invested, managing risk, and making sure your portfolio can survive the moments when the story changes. I'm Nader Nasr, Senior Portfolio Manager and Wealth Advisor with RBC Dominion Securities. If you like this video, then be sure to subscribe and hit that bell icon, and that way you'll be notified when I drop my next video. I'd love to hear your thoughts in the comments below, and if you have any subjects you'd like me to address in future videos, be sure to share those too. And if you have a friend that's worried about a potential AI bubble, do us all a favor and share this video with them. Thanks for watching, and I hope to see you soon.